Right, lads and ladies. Today we're going to be talking about the emotions in trade. No chart work today, but more important, definitely more important than chart work is your emotions in trading. So let's get straight into it. When we talk about emotions in trading, it's important to understand that 80% more 90% of trading is emotions. It's a mental battle when you're trading. Some of the main emotions that we have when we're talking about trading is fear. We have the fear of losing money. We have the fear of missing out. And we have greed. Greed. You have the greed of I want to leave this trade running. I'm up 500 quid, but I want to make 600 quid. So you leave it in, and then you ended up losing everything. Three is patience. We're going to run through all these now in a minute. Three is patience. Four is anger, and five is hope. So you have fear, greed, patience, anger, and hope. They're the most important things about trading. Like I said, trading is a mental battle. It's a battle against yourself in your own head. Anybody can do chart work. You can learn how to do the chart work, no problem. You can learn how to read and understand fundamentals, no problem. But understanding and being able to mentally be strong enough to look at your drawdown, go down, or see profit and take it, or even in some cases see profit and let it run. So not to mess with your risk to reward ratio. Let's get straight into it. We're just going to be reading it as you go down. The importance of emotions in trading, mastering the fear, greed, and patience. Trading is as much a psychological game as it is technical one. While charts, indicators, and strategies are essential, the emotions that drive decision making often determine success or failure. These three primary emotions that influence trading are fear, greed, and patience. Understanding and managing these emotions is critical to becoming a disciplined and profitable trader. One, fear. Fear is a double-edged sword. We have the fear of losing money and we have the fear of missing out. So fear is one of the most powerful emotions in trading. It can protect us from catastrophic losses, but it can also paralyze us and prevent us from taking necessary risks. Fear often manifests in two ways. We have the fear of losing money. Many traders are terrified of losing money, which leads to hesitation, missed opportunities, or exiting trades too early. However, losing is an inevitable part of trading. The key is to reframe losses as learning opportunities. Every loss teaches a lesson, whether it's about risk management, strategy, or emotional control. By letting go of fear of losing money, traders can focus on executing their plan without being emotionally crippled. It's important that you don't tie any emotion to your actual monetary what you're trading. So a lot of people they leave their jobs too soon. They think, oh, I'm gonna go hell for leather now when on this trading gig, and that's the worst thing you can do because that stops that income that you do have coming in. You don't have that anymore, so you can't risk as much. So what you have here, this basket of money that you have here, as you slowly start to take losses, there's no money coming in. So you're slowly just working through the bag of cash that you have. And as you work through it and that bag of cash gets smaller and smaller and smaller, the more you lose, the more stress you get, the more you think, right, well, I need to make this because I need to pay the bills. And that's the last way you want to be thinking about trading. You want to make trading a side thing for as long as you can, and then when the time comes, and you'll know when the time comes, then execute properly, then leave your job, and then be able to trade without the emotion, without the fear. So we have the fear of losing money is our first sense of fear, and then we have the fear of missing out. This is the fear that drives traders to chase trades or enter positions impulsively. FOMO leads to bad entries and unnecessary losses. Remember, a missed trade is always better than a bad trade. The market will always prevent new opportunities, and patience is key to waiting for the right ones. Quality over quantity. A big part of trading, as you'll see now in a few minutes, is patience. It's about being able to sit in your hands and just wait for that markup to come. And if your markup doesn't come, if your trade doesn't come, that's fine. The markets are going nowhere. The markets have been here for decades and they'll be here for decades after we're gone. So there's no point in chasing a trade and I need to make this money today, or I lost this money, so I need to make it back. And that's the worst thing you do. The markets are going nowhere. If you take a loss, take a loss. Don't let it be a loss, let it be a lesson. And every setback we trade, every setback, every pullback is just a setup for an extension, just a setup to keep going up where. Ways we can overcome fear is to accept the losses. They're part of the process. There's no way, nobody wins 100% of the trades. So just accept the losses. There's no point in sitting there dwelling, I lost this much money and feel this sort of way about it. The loss is gone, done. Market doesn't care how you feel. Get on with your life. Get on to the next trade. Understand why you've lost the trade and get on to the next trade. Use proper risk management to limit potential losses. Stick to your trading plan and avoid impulsive decisions. The reason that we have a trading plan is so we can tick off, as we go down, we can tick off the box one after the other, and once all conformances are met, and we back tested our strategy so we know it works a certain percentage of the time. So once all of our conformances are met and we take that trade, whether that trade wins or loses, we're going to be risking what we can risk, what we are able to afford to risk, and no more. People often go in and risk 24% of their account on a trade. But if you risk 24% of your account on a trade, you get 4 trades and your account is gone. If you risk 2% of your account on a trade, you get so much more trades. Imagine risking 2% to 25%. So many more trades. So although 2% of what's the average, say 1,000 quid in an account, it's really fuck all. Like when you think about 2 quid or something, like 20 quid or something, it's not a lot. And you don't stand to make a lot. But it's like that. In your head, you need to get used to adding on a zero. Although you might only be making 5, 6, 7, 8 euro on a trade, or even 70 or 80 euro on a trade, always add a zero in your head, because the only reason that it is 7 euro and not 700 or 7,000 or 70,000 is because you just haven't got the capital yet. But building up the capital, that's part of the process. And that's for, and yeah, we want the risk we can afford to risk. So don't over leverage. Try risk the same amount per trade, and get used to it. If you set a stop loss for 20 quid, in your head, tell yourself that 20 quid is gone. Don't tell yourself you lost the trade, but tell yourself the 20 quid is gone. Detach the emotion from that 20 euro altogether, or 200 or 500 or whatever the dollar amount may be. Number 2, we have greed. Greed is the silent killer. Greed is the desire for excessive gains, often at the expense of rationality. It can lead to overtrading, taking excessive risks, or holding on to winning positions for too long in the hope of squeezing every last dollar. Greed clouds judgment and can turn a profitable trade into a losing one. When we say rationality, we're talking about our rational thinking. When you get greedy, I remember once I had an FTMO 10k funded account, and I was up 800 quid, and you only need to make 1,000 quid on it to pass phase 1. And I was up 800 quid, and instead of taking the 800 quid, I said, fuck it, I'm going to leave it run. And I'm going to let it hit 1,000 quid. It's going to hit 1,000 quid. It's right there. Bang, bust, came around, torn back down. And I never moved stop loss into break even. So I didn't manage the trade correctly. So that's one thing I learned, is I didn't manage the trade correctly. And the second thing I learned is I could have taken partials. I could have taken 400 quid off the table. I could have trailed me stop loss. I could have done one of a million things that I only realized I could have done that after I've lost a trade. So like that, was it a loss? Yeah, technically I did lose, but I only lose what I paid for the account, so 90 euro or something. But I've learned a lot, and I haven't made that mistake again. So like that, look at it like it was just a business expense. Now, the dangers of over trading is greed often leads traders to take on too many positions or trade too frequently. This not only increases transactional costs, but also exposes the trader to unnecessary risk. You'll see people, they might get a signal, or they might take their own trade, and they'll enter into a buy or sell or whatever it may be, and they'll enter in about 6 different trades. And that's fine, that's perfect if you want to layer into a trade, it's no problem at all. But if you want to risk 20 euro on a trade and you decide to layer into a trade, don't risk 20 euro on every single trade. If you're taking 5 trades, risk whatever, 4 quid a trade, 5 quid a trade, and keep your risk at your set risk, and just lower your lot size, and then layer into your trade. That's what it's called when you have multiple positions into one trade. That's called layering into a trade. And now the pitfalls of over leveraging. Greed can tempt traders to use excessive leverage, amplifying both gains and losses. While leverage can boost profits, it can also wipe out an account that's not used properly. A lot of people misunderstand leverage, and look at the leverage video that I'm going to make, and understand it fully before you go in and try to get the highest leverage. Some brokers offer something mad, like 1 to 500, 1 to 200, 1 to 100 leverage. There's a lot, and people think, oh well, if I have 1,000 quid in my account and I have 1 to 500 leverage, that means I'm going to be able to risk 500,000, or I'm going to be able to make a lot size that would allow me to risk that much money as if I had that in my account. That's the way it works. But you might be able to gain a load of quid, but if the trade goes tits up, you're done. That account is blown. At a 1 to 500 leverage, gone. Good luck. Never going to happen. Try to keep your leverage small. Trade with leverage if you understand what leverage is. But there's no harm in with not trading with leverage either. Aim for 1 to 10, 1 to 30, 1 to 100 max is what I'd go for. I wouldn't go anything more than that. And still at a 1 to 100 leverage, I wouldn't never risk what that allows me to risk. Just because I'm able to risk 10 lots doesn't mean I'm going to risk 10 lots. Just gives you that option if you want it to be stupid. Like. Now, how we overcome greed: set realistic profit targets and stick to them. Avoid over leveraging and managing your risk carefully. Focus on consistency rather than chasing huge wins. Consistent wins are better than diving into the market, making a load of money, and then diving into the market and losing a load of money. You'd rather stack small wins consistently than the big win every now and again and the loss every now and again. And you want to be consistent with it. And it's very important, again, like I said before, is set your profit targets. Don't, if you're trading gold, for example, if you're trading gold with a 0.01, it's tough on the head, because if you're getting in and you're aiming for 100 pips, 100 pips is only a tenner, but 100 pips at a 0.1 is 100 quid, at 100 pips at a 1.0 is 1,000 quid. So it's really important that if you're right, if your analysis is correct for the 100 pip move, that's good enough. That is good enough. That is perfect, because your analysis was correct. And the only reason that it's a tenner that you're making because you're trading 0.01 and at 1,000 trading this one standard lot is because you haven't got that capital yet. But you can always build on the capital. Making sure your analysis is correct is just as important as, it's better than going in and saying, oh, well, I'm trading with a 0.01 and then trying to catch a 700 pip move just so you can make them easily 70 quid. Make your 7 quid. Secure your €7, and in your brain tell yourself that you're after making the 70, that you're after making the 700, that you're after making the 7 grand. It's all a mental game, and you need to convince yourself that you have that money in the bank, that you're after making this money. And it's hard, but once you do it, it's hard, but once you do it, it sets you up well for the future. And a good way to do it as well, what I have people start with, is open up a demo account for 100 grand. 100 grand demo costs you nothing at all. Play around with it, especially if you don't know how to trade. You're brand new. Play around with it. Go in, lash on a big massive lot, 10, whatever, 20 lot, whatever it may be, on whatever currency pair, whatever commodity, whatever it may be. Dive into it and see the money going up and down. See how 100 pip looks on gold at a 10 lot. Mad. You're talking 10 grand there, more probably. And again, with other currency pairs, whatever it may be, get the experience in and be able to see the numbers. Take your phone and see the numbers go up. Although on your account they might only go up 7 quid, but trade the same trade on a demo account and use a 10 times larger lot size, just so you can understand and build that in your brain, build that mental strength that you know in the future you are going to be making that money. And right now you're not, but in the future you will be. Now, number 3, very, very important, is patience, the trader's greatest virtue. Patience is a cornerstone of successful trading. It is the ability to wait for the right opportunity and not act out of an impulse or emotion. Patience allows traders to remain disciplined and stick to their trading strategies, even when the market seems chaotic. Letting trades come to you. Instead of chasing trades, patient traders wait for high probability setups that align with their strategy. This reduces the likelihood of bad entries and increases the chances of success. Avoiding emotional reactions. Patience helps traders remain calm during market fluctuations. That grub is repeating on me. During market fluctuations, by staying composed, traders can make rational decisions rather than reacting emotionally to short-term price moves. When we say rational thinking or rational decisions or rationality, we're talking about thinking that position through. So if you're I'm after losing a trade, so I'm going to dive into another trade now and I'm going to make money back, that's irrational thinking. You're not you're not ticking off these boxes in your trading plan. You're not sitting down looking at the technicals and fundamentals of where the chart might go. You're saying, right, well, I'm after being in a buy and it's after selling, so it's going to keep selling, because I guarantee when you keep selling, it's going to buy and you're going to be fucked both ways. Then it's going to take out your buy and then it's going to take out your sell, and then you're going to blow your account and you're going to keep going until you blow your account, and then you're going to turn around and you're going to say, that's a scam, I'm not doing that. When in reality, you should have just sat in your hands, take your loss, journal your loss, realize why you lost, and get on with it. Get on with it. Because like I said to you before, the market doesn't give pants about your emotions, about you. It doesn't care about anybody. It takes your stop loss out, puts your account, and it goes and it moves on to somebody else. How do we cultivate patience? Develop a clear and concise trading plan and follow it rigorously. Practice mindfulness and emotional detachment. Remind yourself that the market will always provide new opportunities. It's important, especially when you're coming out of just working a normal job. You're tied to that, right? Well, my time is worth 20 quid an hour, or 15 or 8 or whatever it may be an hour. So if you lose 100 quid in a trade, you're saying, right, well, that's a whole day's wage. I'm down 8 hours of my life now because I'm at the losing this trade. Take that emotional detachment away from the money, and trading gets a million times easier because you're not trading for the money. Then you're trading to be correct. You're not trading to make 100 quid out of a trade. That's the same much as your wage. You're trading because price should go to this high because that's where the liquidity level is. Do you understand? Hope you're staying with me now. Now we have 4. So these are the 3 main ones. We have fear, we have greed, and we have patience. So then we have 4. We have anger. Everybody's experienced anger in the markets. I can tell you that. If you have a blown account, there's nothing more frustrating than blowing an account. Anger is a powerful emotion, and in the world of trading, it can be as destructive as wildfire. When anger takes hold, it can burn everything around you, your discipline, your strategy, and ultimately your account. One of the most dangerous manifestations of anger in trading is revenge trading. This is the number 1 symptom of anger in the markets, and it can lead to a vicious cycle of poor decision making. A vicious cycle of poor decision making. I'm telling you now, if you get angry at the charts and you think you're going to go in and you think you're going to get back at the charts, do the charts over, the markets are either winning me on this buy order, but I'm going to catch them on this sell order. You're never going to catch them. You're never going to catch the markets on the sell order. Not if you're going in thinking that way. Anger clouds judgment. When we are angry, we stop thinking rationally. Again, rationally, we lose that rational thinking. You're not thinking logically. You're thinking on the spot of getting this money back. You're not sitting down and thinking, right, well, what's the best way to do this? Or why did I lose that trade? And how can I use that to better the next trade? In trading, this often means that taking trades out of frustration rather than logic. Revenge trading is a prime example of this. It occurs when traders are, after experiencing a loss, try to get back at the market by taking a high risk trade without proper analysis. This is like adding fuel to the fire. Our anger grows, but our account size shrinks, creating a destructive spiral. When we revenge trade, we are no longer in control. Anger takes the wheel, and we act on emotion rather than strategy. Much like seeing red, we lose sight of our goals and focus solely on recouping losses. Losses are inevitable. No trader wins 100% of the time, and accepting losses is a key part of the trading game. It's very important that you just be able to accept the losses, and it takes a while. And if you can't do it now, just know that you're going to be able to do it in the future. Whoever's watching the video, you're going to be able to do it in the future. But that emotional attachment that you have to the money, it's just genuinely, it's just to the money. Because you think if you weren't trading and it wasn't a demo account, then I always tell people to start with a demo account. But for a lot of people, it doesn't really help. You know what I mean? Because you can say, oh, I'm not been trading this demo account, I'm not being profitable for 3 months. When you go onto your live account, it's different, because like that, you are working for that money. You have worked for that money. So if you lose it, you do have that attachment to that money because you've worked together. And whether you like your job or don't like your job, especially if you don't like your job, it's going to make it even worse or even harder. And step to manage anger in your trading. 1 is recognize the anger. Hold the thought captive. When you feel that anger coming in, understand that that's why you're feeling it, because you've lost a trade, and accept it. Accept the anger. The 4th step is to acknowledge when you are feeling angry. This self-awareness is crucial to preventing impulsive decisions. Number 2, notice revenge trading. Revenge trading will catch everybody in the day. Everybody's a culprit of revenge trading. Be mindful of the urge to revenge trade. When you feel it, stop and take a step back. Remind yourself that revenge trading only leads to more losses. Accept your losses. Understand that losses are part of the game. No trader wins every trade, and accepting this reality is key to maintaining emotional balance. If you're on a losing streak, every trader encounters a losing streak at some stage, at some point. There's no trader worth their money that hasn't encountered a losing streak. So when you do have a set in your trading plan, only take so much losses, whether it be a certain amount of trades lost or a certain dollar amount lost. Have that in your trading plan, so there's no way that you can blow your account. If you have 1,000 quid in your trading account and for some reason you're either blowing 300 quid in a day, stop trading, man. Stop trading. Sit in your hands. Now, that's not to say don't look at the trades and mark out the trades and understand the trades, but stop taking the trades, because I promise you now, it's just luck. It's just the luck we all have. We all have just that luck. And when you take the trade, eventually it's gonna win, and they all lose, and then the one that you mark up, it goes to TP, and it's the one that you don't take. But that's just trading. Your lad, add 40 years onto your life, give you great years. 4, journal your emotions, write down your thoughts and feelings at the each trade. Use this as an opportunity to reflect and identify areas for improvement, and adopt the boxer's mindset. Like a boxer approaching trading, approach trading with focus and discipline. Win or lose, review your performance and learn from it. Before we move on, write down. I didn't do this for ages. I haven't done it for ages. Write down your emotions. People journal their plans, but they journal their technicals, they journal their fundamentals, and they journal what they could have done differently. When you're journaling your trades, oh man, when you're journaling your trades, make sure you're adding in how you're feeling during the trades, before your trade, during your trade, after your trade. So you don't just want to improve on your fundamentals, technicals, stuff like that. You want to be able to improve on your emotions. So if you see that, for example, 6 months ago, fuck me, man, excuse me. If you see that 6 months ago, I was anxious before I was taking the trade, and then I was fearful when I was in the trade, and after the trade I felt regret because I took it out too early. And then when you look back in 6 months time, and 6 months on, then you look back and say, well, that's good, because I don't feel any of those emotions anymore. All of those emotions are gone away from me now. That's what you want. Anger in the markets is a dangerous force. It can be managed, but it can be managed by recognizing anger, avoiding revenge trading, and channeling emotions into productive reflection. We can protect our accounts and improve our trading skills. Remember, trading is a marathon, not a sprint. Stay disciplined and focused. Not always know, and always strive to learn from your experiences. Just like a boxer in the ring, your ability to control your emotions will determine your success. 5 is hope. Hope. There's a saying that say people should be hopeful. People are hopeful when they should be fearful, and fearful when they should be hopeful. So you're in a trade, or people should be we go with this one first. Easier for you to understand. People are fearful when they should be hopeful, and hopeful when they should be fearful. If you're in drawdown, you're in a buy position and you're in drawdown, you're hoping price is going to go up. You're saying, oh, so you're fearing, I'm going to lose the money, I'm going to lose the money, I'm going to lose the money. And then when you're in, when in reality you should be saying, right, well, I hope I'm going to get out of this trade. But when you're in profit, you're saying, oh, I hope this keeps going, I hope this keeps going. When in reality you should be afraid that it's going to come out. Do you know what I mean? So you want to, like that, you want to just take the emotion out of it altogether, because if your risk management is on par and you know how much you're risking, and you've accepted defeat, that if you lose this amount of money, but then that amount of money is gone, that's fine. The hope is gone, the fear is gone, the greed is gone, the anger is gone, everything's gone, because you're like a robot trading them. Now, hope can be a double-edged sword in the markets. While it fuels optimism and keeps investors engaged, it often develops into wishful thinking, especially when people equate hope with quick money. Many traders fall into the trap of believing that the market will simply do what they want, ignoring the importance of structure, strategy, and risk management. Hope in this context becomes a dangerous emotion, leading to poor decisions like holding on to losing positions in the belief they'll turn around. This is where tools like stop losses come in. They remove any emotional reliance on hope by objectively allocating risk and cutting losses before they spiral. As the famous quote goes, people are fearful when they should be hopeful, and hopeful when they should be fearful. Success in trading isn't about hoping for the best, it's about planning for the worst and letting your strategy guide you and not your emotions. There's a brilliant book called Trading in the Zone by Mark Douglas, emphasizes the importance of achieving the state of emotional detachment while trading. The market is indifferent to your feelings, doesn't care. Going to take your stop loss, take somebody else's stop loss. Doesn't care about you, doesn't care about your feelings. So there's no point in you getting angry about something. You ever heard the saying, like, if there's no point in me getting angry about him because he doesn't care how I feel, or he or she or whatever. The market doesn't care how you feel, so there's no point in you even feeling anything towards it. So getting emotionally worked up serves no purpose. To trade successfully, you must adopt a mindset where fear, greed, and impatience are minimized. Becoming emotionless, the goal is to trade based on logic, strategy, not emotions. This means accepting wins and losses are part of the process and not letting them affect your mental state. Instead of fixating Focus on the process, not the outcome. Yeah. Instead of fixating on profits or losses, focus on executing your plan flawlessly. Trust that the consistent execution will lead to long-term success. In conclusion, emotions are integral part of trading, but they must be managed effectively to achieve success. Fear, greed, and patience are amongst the primary emotions that influence decision making. By overcoming the fear of losing money, avoiding the pitfalls of greed, and cultivating patience, traders can improve the performance and achieve consistency. Remember that the market doesn't care about your feelings. Trading in the zone requires emotional detachment and focus on the process. By mastering your emotions, you can transform by trading from a psychological battle into a disciplined and profitable endeavor. Remember, trading as well. Percentages. Instead of being attached to that monetary value of the trade, whether it be a take profit or your stop loss, try trade percentages. Now, I'm only starting to trade percentages myself because it takes that monetary issue out of it. You're trading, well, you might be risking 1% to make 3% of. It doesn't matter what 1% or 3% is of your account, because 1% might only be 3 quid or 30 quid. When you're risking 3 quid to make 9 quid, 10 quid, it's not a lot. But if you look at it as a percentage and you're saying, right, well, I'm up 10% on this account, but 10% is a lot. If you might only have 100 quid in the account, 10% might only be a tenner. But if you had 100 grand in your account and you're at the making 10%, that's 10 grand you're after making. And it's all about being able, especially with trade when you're starting off, it's all about being able to see into the future and understand that you will get there eventually, and there's just necessary steps that you have to take in order to get there. Yeah, handy. Let go of the fear of losing money. Losses are lessons. Every setback is a setup for success. Avoid greed by setting realistic goals and managing your risk. Cultivate patience and let trades come to you. Trade in the zone by staying emotionless and focused on your plan. By understanding and managing these emotions, you can unlock your full potential as a trader and navigate the markets with confidence and discipline. Now, risk management and emotions, they're going to be up there. Actually, not up there. They're the most important things about trading. And when you look on YouTube, you search up trading, a lot of the videos are going to be technicals analysis, fair value gaps, order blocks, equilibrium, daily buys, blah, 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 whatever it may be, whatever it may be, support, resistance, demand, supply, whatever it may be. Nobody teaches the core concepts of the mentality that you need to trade it. That's why we have iron mine trading. That's the whole point of the iron mind trading. You need to be able to trade with a steel mind, with an iron mind, and not let anything affect you. You take a loss onto the next one. You take a loss onto the next one. You take a loss onto the next one. But when you win, you win big. And if you lose 3 trades, it might only take you 1 trade to get back into break even, and then 1 trade to get up 3%, and then 1 trade again, and then you're up 6%, and then you're up 8%, and then you're up 10%, and then you keep going up. I'm telling you now, don't overlook, and I can guarantee this video along with risk management is going to be the videos with the least amount of views, because nobody wants to focus on the risk, nobody wants to focus on their mental, everybody wants to focus on the technicals, because I think that's all trading is, when it's not. In reality, it's really not. But that has been emotions in trading. This is going to be link for this is going to be down below. I'll leave the link for the book down below as well. You can get it. I'll actually leave the link for the PDF down below as well. You can get it online for free, so you may as well take advantage of it. I can't remember whether it's on Audible or not, but it might be. I think I still have it up there actually. Yeah, I do. But that's emotions and trading. We leave with that, and I will catch you in the next video.